Good afternoon, everyone, and welcome to our webinar, Revenue Auditing, Lessons Learned from TDT. I'm Janice Kaplan, the Content Marketing Specialist for James Moore & Company, and I'll be your host today. With me to present is James Moore partner Zach Chalifour. For those of you who haven't met Zach, he leads our government services team and has nearly 15 years of accounting and auditing experience. Zach has been the driving force in establishing our tourist development tax audit services, and he spearheads our TDT engagements. As you can imagine, he's a great resource to cover this material today.
All right, thank you, Janice, and good afternoon, everyone. So we are here to take a look at revenue auditing as an overall concept, although the real angle that we'll be talking about this today is going to be from the TDT angle, which is tourist development tax. What we've done there in recent years, and also some presentations that we've done, really helped generate the material for this, although while much of the focus will be on TDT auditing, there's many areas and concepts that can apply to looking at revenue auditing overall. So we're going to try to look at it from all angles, take a big picture look to say, okay, what areas are there that there may be some opportunities to look at different areas that could be subject to revenue auditing. So in terms of our agenda for the day, first, we're just going to take a look again at how we got here. Why are we talking about revenue auditing? And let's try to put a definition to it to help set the stage and get everyone thinking about what opportunities might there be in your organization to consider starting to perform different revenue auditing procedures if those might be worthwhile to look into performing. As part of that, we're going to talk about just the why behind it. What are the benefits to performing revenue auditing? And what really can you accomplish, even if it's not a hard dollar benefit, but there are some soft dollar benefits in there as well to performing revenue auditing and similar procedures. Once we kind of set the stage in terms of what it is, why to perform those audits, we're going to get a little bit more specific to talk strategies to some degree and really look at a lot of these different areas largely from the external audit standpoint. Of course, as a firm that specializes in external audits over governmental and other entities, that's really our bread and butter, kind of the way that we are wired to think. But many of the areas that apply to an external audit can be related back to the revenue auditing side, first in terms of just determining what the scope of such audits might look like, as well as what the audit plan is going to be. And then we'll talk a little bit too about audit selection processes in terms of saying, okay, we know we want to do an audit, we think we know what we want to look at, but how do we decide where to start, who to look at, what contracts or otherwise to test? And then we'll also throw out some ideas about performing the audit, how to do so efficiently and get the best bang for your buck in any areas where those revenue audits are going to be performed. So before we get any further, I did want to come up with a definition that could be applied for purposes of this presentation to say, okay, when we use the term revenue auditing, what exactly are we looking at? So the definition that I came up with as listed on the screen, we're going to define revenue auditing as the undertaking of any audit or review activities related to the accuracy and completeness of variable revenues that are legally or contractually due from third parties and are subject to error or fraud by the third party and for which the receiving entity, your organization, also has the right to audit. So while some revenues that might be received in accordance with a contract, let's say for a rental agreement, there's a specified number of dollars that are paid on those every month. There's nothing in question or that could be manipulated. It's very cut and dry what those revenues should be. So what we're going to look at is those where there are revenues coming in, but the accuracy and legitimacy of those numbers is outside of your organization's direct control. That really covers the error or fraud applicability and the variability. And then, of course, there would have to be a right to audit. On the tourist development tax side, those just statutorily, that right to audit is provided. So again, that's why this has kind of been the main focus. As we have a handful of counties that we work with to aid in their TDT audit efforts. But many revenue contracts and those where there are some degree of variability, many of those do have clauses that allow for the right to audit and inspect records of the third party. So those are the types of agreements that we'd be looking at that could potentially be subject to what we're going to talk about here today. A few examples of some revenue audit scenarios. Of course, tourist development tax is the primary area that we will be relating much of this back to. But looking at some other areas that could be subject for local governments, in some cases other organizations where there is, say, restaurant space being leased out in buildings that, say even a university might own. A few variable revenue stream ideas that we've got here is restaurant sales, where there might be an agreement that says there's a base rent, but then also payable by the lessee is a certain percentage of sales or some other additional variable payment that is based on the actual activity of that third party. A couple other examples on the advertising agreement side. We've seen some scenarios where the right to handle advertising for different items, whether it's, say, billboards, bus benches. We've seen scenarios where there's contracts that basically allow for the entire management of that advertising activity to be assigned, delegated to a third party, and then that third party has the full right to obtain advertisers, sell the advertising, and so forth, and then there's a percentage payment or otherwise that could be due back to the originating entity based on the volume of that advertising activity. Another common example is parking contracts. So whether it's a parking garage, beach parking, or anything else where there's a third party that handles all parking revenue, on many of those cases, there's simply a calculated dollar amount based on what commission those third parties are able to take, and then they remit the balance of those revenues to the original governmental entity. But in many of those cases, it's just there's a monthly payment that comes in, and in terms of receiving the payment, there's no other way to say, yes, this is in fact the proper amount. So many of those contracts, of course, also have provisions that do allow for the right to audit the financial activity of those contractors in terms of what are they actually collecting and then what are they remitting. So again, those are a few examples, but as we talked about in the definition, anywhere where there is some degree of variability, it's based on what that third party is doing and how they are administering and collecting those funds. Any of those areas are those that could be subject to audit and consideration as we look at the revenue auditing side. So in terms of how we got here, really what brought this up as a topic for consideration is as we've gone through some of our webinar series this summer, we've talked about budgeting in a COVID-19 world, looking at, okay, what are revenues going to look like? And that really ties in here to say, okay, well, revenues from some of these sources are going to continue being what they are in some cases, but what opportunity is there to say, let's make sure all of those revenues are in fact the proper amount. So it seemed like a very relevant area to look at and drill in a little bit to how to potentially supplement those revenues and make sure that the revenues being remitted are what should be. The TDT audit history, as I mentioned, this has been kind of the main focus or the bread and butter. For about 5 years running now, we've been working with a growing number of counties working through those tourist development tax audits, which in all reality, it's much more structured than some of the revenue audit considerations we would get to, just because for most counties, there's hundreds, if not thousands of taxpayers, and everything follows the same general flow of information in terms of the tax returns that are submitted and so forth. So those are a little bit more tangible to look at, and why I thought it would be a good baseline to talk about just revenue auditing as a whole. Looking at revenue audit history, we've had a few instances with clients where we have come in to assist in some scenarios, and we've been made aware of others. We've reviewed agreements, say, okay, is there an adequate right to audit being included in that agreement before the entity actually finalizes the contract with the third party. So we've seen many scenarios where revenue auditing has been a pretty successful process to go through, and other areas where the opportunity is at least there, even if it has not been exercised at this point in time. The comparability, as I mentioned, overall, many similar aspects of both the TDT and the revenue audit side. And then in terms of the traditional audit theory, as I mentioned earlier, well, of course, it's different. An external audit is very structured and has certain criteria specific to external auditing. Many of that traditional audit theory can be applied in different ways to revenue and TDT auditing. And as we go through this presentation, we are going to touch on a few examples where we've and show how we've applied some of that theory to make those TDT audits ultimately as meaningful and efficient as possible, because as we talk about some of the challenges and barriers, just the cost of performing such audit, having the resources will definitely be a huge part that we talk about in terms of why isn't more revenue auditing being done in certain cases. So first, looking at just audits and saying, well, why should we do revenue audits or anything along those lines? So what we're going to do for much of the presentation is basically relate back to first the financial statement audit side to say, well, here's what we see in a financial statement audit world, and how does that relate to this whole concept of revenue auditing? So first, looking at the financial statement audit side, of course, it is required to be performed by certified public accountants. The emphasis here on public in the sense that it is overall the audit performed to benefit the public as a whole by ensuring that financial reports and otherwise are in fact accurate. And if there is any material fraud, the audits should be designed to help detect that fraud, again, to help overall maximize the public trust in those financial statements that are being audited. On the revenue and the TDT side, those, instead of being performed by certified public accountants, basically are being performed or at least overseen by the public entities who are receiving those funds. And in terms of what the goals are of such audits, on the TDT side, just like anything from a tax standpoint and what the responsibilities are of tax collectors' offices, it's ultimately to help provide for the fair and equitable administration of those tax dollars. And on the revenue auditing side, really it's to help ensure compliance with the contract terms, and at that point in time to also, much like we talked about fair and equitable administration, it's ensuring that the proceeds being paid to the government in accordance with those contracts are in fact fair and equitable, and there's no special benefit being obtained by that third party by potentially not remitting what they should be, or any other issues that could occur, whether it be due to error or fraud. So looking at the audit objectives and procedures, and this is, I think, one of the barriers for many when looking at the opportunity to perform revenue or TDT auditing. It was one of our most substantial challenges the first time that we got involved in a TDT audit situation, just trying to figure out, okay, what will this look like? So first, on the financial statement side, an audit is very clearly defined by the AICPA audit standards that it is designed to provide reasonable assurance about the reliability of the financial statements. There's very specific criteria out there with regard to the performance of both substantive and analytical procedures. And again, also explicit requirements related to the understanding that must be obtained of the entity's internal control environment who is being audited. On the review side, just as we look at different levels of audit overall extensiveness, there's a review that talks about providing limited assurance, and again, very specific procedures that are required that relate to both inquiry and analytical procedures. On the financial statement side, the lowest level of assurance is a compilation and a preparation where no assurance is provided. The key here is there's different levels of services related to financial statements and audits thereof. All of those have very explicit requirements, and it's very tangible in terms of what must be done at those different levels. The challenge, of course, on the revenue and the TDT audit side is it's just a whole bunch of gray area. There's no specific criteria in terms of here's exactly what your revenue audit must look like in terms of how many audits are being done, how extensive, and so forth. So when you don't have that black and white model to follow to say here's exactly what must be performed, that is kind of the initial barrier. If it can be a huge undertaking just to come up with, well, what should we be doing? What would it look like? So much of what we're going to talk about as we go through everything some more are different ideas in terms of how we've identified the most effective procedures to perform, both at a high level in terms of just the audit plan, as well as all the way through the actual audit testing, because again, that I believe is one of the most substantial barriers, just because it's very, you can't put a finger on what must be done, and you've kind of got to figure out what those audits are going to look like, what that plan is going to look like, again, without having a tangible guide or specific rules to follow that kind of dictate what that plan is going to look like from square one. Looking at audits and just the other benefits to consider when you say, okay, should we go ahead and start performing some sort of revenue auditing procedures? One of the benefits of audits just in general that I always like to throw out there is the security camera effect, I call it, where we talk about preventive versus detective controls. In the internal control world, those two different types of controls, preventive, of course, is something that is designed to prevent an error or fraud from even happening in the first place. A detective control is one that is designed to detect whatever might have happened, again, whether due to error or fraud on the back end. So let's take a very simple example and say if you're in a financial system and we're talking about who can prepare journal entries. The preventive control would be that there's multiple people that must go in a separate approval process for a journal entry that just says, okay, no one can go in on their own and book an inappropriate journal entry, where on the detective side, that detective control would be a review after the fact, looking at any unusual activity that may have already taken place. So as we look at that on the revenue audit side, an audit, of course, is a detective control. If there is a revenue audit situation, whatever has actually happened and taken place and was remitted, that's past history. And in performing that audit, you're looking at validating and verifying whether the revenue that came in was in fact proper. So while conceptually it is a detective control, the analogy I always like to use is that there's also a preventive benefit to performing such audits. And where that comes into place in the security camera effect is, let's say you're in some office, there's a security camera there, let's say you're at a grocery store, gas station, paying for items, there's a security camera there. If somebody was to take money from the cash register when the clerk's not looking, that's one where when you consider security cameras, the camera is not going to prevent that person from taking those monies, but the fact that it's there as available as a detective measure is going to help, hopefully, in a lot of cases, deter those from doing what they shouldn't. So as we look at the audits, if there's a audit procedure in place, it's known and it's out there that audits are being performed, there's a certain level of preventive control measures that are there when folks think about the fact that, well, hey, this might be selected for an audit. We don't want to take any risk that something is being done improperly or otherwise. So that is one huge benefit that I see to audits, even if there's not a huge detection result that comes out of it. Just the fact that the threat, so to speak, of an audit is there, certainly for any of those third parties, elevates their degree of honesty in most cases, just knowing that they're not going to just point blank get away with anything that might be improper or incorrect, regardless of what happens, because they know nothing will ever be selected for audit or looked at to verify whether it is in fact proper. On the training opportunity side, this again mostly relates to the tourist development tax side. What we've noted is many of the times that we found issues in performing those audits, most issues are there's not an intent to do wrong. Generally, the issues have been caused by just a lack of knowledge or experience. So what we found is that in performing the audits, in addition to the preventive control measure that takes place because folks are aware the audits are being performed, there's also an opportunity to train taxpayers in that sense, make sure that everyone is aware of what the requirements are, what taxes should be collected and remitted on. And in some cases, those training opportunities simply help ensure compliance. And in some cases, folks are talking with others, and just the knowledge of the taxpayer base as a whole grows over time, which again helps ensure compliance and provide additional benefits beyond just the individual audits that are being performed. So with that, we have our first polling question. Janice, I'll turn it over to you.
Okay, here we go. Just a quick note, you may need to exit full screen mode to view the polling question. The question itself should be in a blue square right there. And that question is, to what extent has your organization performed revenue auditing? So is it an established process periodically? None, but we need to start, or none, and I'm not sure what we would audit. So I'll give you about 10 seconds more to answer that question. Please get your questions in, or answers in. We'll wait about 5 more seconds. Okay, we'll go ahead and close out the question and let's see the results. Zach, go ahead.
All right, so it looks like we've got a little bit over half with a periodically answer, almost a quarter with an extensive established process, and only 15 or 14% with the none and not sure answer. Overall, I think that probably there's a little bit more revenue auditing going on than I was expecting to see on this question, so that definitely is good to see. But for many organizations, I definitely understand the not being sure where to start. In a lot of cases, there might just not be any contracts that truly meet the criteria. But again, good mix there. Good to see that whether it's extensive or periodic, over 3/4 of those participating, there is some degree of revenue auditing taking place. So now we've talked about just the what and the why behind revenue auditing. Let's take a little bit of a look at planning the audit, determining what the scope of those revenue audits might look like. So again, doing a comparison between first the financial statement audit side, when we're trying to figure out what the plan and the scope of those audits will look like, the areas we have to focus on, again, are generally very defined. We know we have to perform certain substantive testing. So the question is not really what to do, it's just determining, okay, what's our risk? And based on that risk, what should our sample sizes look like? And how in-depth should some of those procedures go? But again, we already have a very tangible idea of what we're looking at. It's just determining how risky is it and what should we test? And then reasonable assurance, of course, is the end goal of a financial statement audit. And that is a very ambiguous to some degree concept going through the risk assessment process and otherwise, but it's at a very high level, again, looking at the financial statements, and there is lots of guidance in terms of, okay, based on your risk, how much testing must be performed to obtain that level of assurance. On the revenue and the TDT audit side, first and foremost, looking at the TDT side, the first question that tax collectors' offices, clerks' offices, or whoever is tasked with the responsibility to perform TDT audits and also look at enforcement is first just where the focus should be in terms of enforcement versus actual audit work. The difference there in general terms is that enforcement says, are those who should be paying taxes actually remitting taxes? And this has been a huge issue in the TDT and the bed tax world with Airbnb and others, where folks are renting properties and potentially no tax revenues are in fact being collected when they should. And then the audit side is really looking at, okay, what tax returns were filed and selecting actual return data from actual taxpayers and going in to actually audit those returns and look at them for completeness and accuracy. Once there is a decision to look at the audit side, the questions then are, again, pretty ambiguous in terms of figuring out what the scope is going to look like. Again, there could be thousands and thousands of taxpayers. So when you look at the audits, first it's, well, how many audits should be performed? How in-depth should those audits be? And then which taxpayers should be selected for audit? So lots of considerations. And again, no real guidance or rules in terms of here's a cut and dry requirement as to what those audits and what that audit plan must look like. On the revenue audit side, very similar. And again, first, it's just figuring out, okay, what contracts could there potentially be that are subject to this whole revenue auditing concept that we're talking about? And by that, it would be which ones have that variability criteria as well as the right to audit. And then once you've identified that population of contracts, the question again becomes, well, which ones should be audited and how in-depth should that actual audit work be? So as we go forward, we'll talk about different considerations that can be used to help guide some of that decision making to just figure out, okay, what should this scope look like? One of the other barriers in terms, after first we had just the gray area trying to figure out what everything looks like, the next major barrier, of course, is just the limited bandwidth that many government organizations have. It's not like as your current entities are structured that there's just a handful of people that have all sorts of time on their hands and don't know what to do with it. So sure, let's go have them do a handful of revenue auditing. I'm sure many of you wish that were the case, but that's just, of course, not the economy and otherwise that we're in, where with many financial operations for local governments, higher education, and otherwise, there's just this ongoing resource struggle in terms of so much work to get done and only so many resources. So that's one of the areas of concern, but in looking at it, there are going to be some cost benefit considerations to look at in terms of saying, well, how could we perform more revenue auditing and what is the true value of doing this? What sort of emphasis should be placed on it? We do have I did pull here a quick survey that we had conducted amongst the FTTA, which is the Florida Tourist Development Tax Association, a couple years ago, just to say, okay, what were the biggest barriers to performing TDT audits, whether it's to perform more audits or just to get started. The biggest areas were, of course, first, personnel constraints, and then second, budget. I think this would be very similar to what the results would be on the revenue audit side, where notably the past ineffectiveness and then also cost and benefit of such audits, those were the two lowest rated items in terms of not really being true barriers to performing this work. Because again, as we talk about more, much of what I've learned is that even if you think there might not be a substantial risk, there can't be that many issues going on or problems, what I've kind of learned is that was my thought originally, and I was absolutely wrong. The first time that we went in to perform TDT audits, just conceptually, I thought about it and said, okay, well, it's really not that complicated. It's just there's a certain rent amount that's paid for a condo or a hotel room, and then there's a specified tax rate that is charged for sales tax as well as the local TDT tax. And then once we got going into everything, my perspective totally changed when through all the hundreds of audits that we've performed, it is generally much more likely than not that there is going to be some sort of an issue on any single taxpayer account that you might select. So what we've seen is that the cost benefit can be there, but just the actual effectiveness of the audits there in most cases is probably going to be something to be found in performing those audits. Taking a quick look back at what we talked about a few weeks ago when Mike Sibley spoke about Lean Six Sigma, to just take one quick look at how do we establish the resources, obtain the bandwidth to perform more revenue auditing activity. Looking at the Lean Six Sigma principles, this is one where in looking at the benefits of trying to establish a more lean culture, going through potential process improvement activities, as Mike mentioned in that webinar, the goal of establishing some of these efficiencies through Lean Six Sigma and otherwise is generally it's not going to be to say, okay, let's get more efficient and we can lay off individuals or reduce the workforce or something like that and just save costs. It's really about value and efficiency to say, okay, well, if we can get other processes more efficient, what capacity might that open up to help in other areas or achieve other objectives of the organization that we just currently don't have the resources to perform. The quote here, of course, moving fast is not the same as going somewhere. So while everyone might be busy, the question is the work being done as efficiently as possible? Or in theory, if you spend an hour constantly moving to avoid traffic, to take the long way around for a 15-minute drive that actually would have just taken 30 minutes in the traffic, well, sure, it felt like you were being productive because you were driving, but you were not as efficient in the end result of that entire drive as you would have been otherwise. So the efficiency is really the big piece here to say, how can you, through efficiency in whatever area of your finance team or your organization's operations, what can you do to help develop more capacity in other areas? And then on the quality side, of course, one of the key areas that we look at on the audit side and just in general is having those processes in place that everything is helping drive a high quality product in terms of the work that is being performed, the review that's taking place, and otherwise, where here the quote we have is there's never time to do a job right, but always time to do it over. Whatever process improvements that can be made to increase quality, largely through consistency and good internal controls and processes that are also efficient, by not just completing things quicker, but also at a higher level initially, that can help save review time and other resources that might be involved on the back end if there are certain areas with issues or that require extensive review and corrective activities. That's another way to potentially help increase capacity. And the end goal here, of course, is by getting these improvements, you can provide more value to your stakeholders, whether it's the citizens, the board, or otherwise, by taking some of those resources that are saved and reallocating to other goals and objectives, again, whether it's revenue auditing or anything else. So looking at Lean Six Sigma and a little bit more about how we specifically can relate it back and some of the key concepts that we consider is when we're performing a financial statement audit, we have basically three overarching considerations that we have. The first and third on this list is basically, is it either required or providing value externally? So if it's something for the benefit of the client, then by all means, we want to make sure that we're performing that aspect of the audit or a certain procedure. If there's a regulatory standard that requires a certain procedure, well, then of course that means it's going to be performed. The other key area is if it provides value to James Moore in terms of in our performance of the audit and what we feel adds value to give us comfort with regard to expressing a unmodified opinion on the financial statements that those are fairly presented. So when we look at it and say, okay, is what we're doing, is the time worth the benefits that it's providing us in terms of being able to provide that assurance on the financial statements? So on the revenue or the TDT side, what we kind of look at the same way, talking about what sort of value does the audit activity provide, is first, does it provide value to the office in terms of saying, okay, does that give you more confidence that your organization is properly managing what it should and again, maximizing revenues? And the second piece is looking at the value to the citizens or the taxpayers as a whole, basically any of the stakeholders in your organization. As we talked about on the TDT side, much of the focus there is really just all about the fair and equitable administration, that there's no taxpayers getting an unfair benefit, there's no third parties that are collecting revenues partially on behalf of your organization getting any sort of an unfair benefit or taking advantage of your organization, so to speak, at the expense of those other stakeholders. So that's kind of the piece to say, okay, well, is this something that should be done as part of providing that value? Once you say, yes, this should be done, then you get to more of the cost benefit considerations, starting with just the dollar cost. Say, okay, what's it going to cost to perform certain testing, and what could be the actual fiscal impact in terms of how much revenue might it generate? If there's something where you're spending an additional 8 hours worth of time to potentially find something that's going to have a $20 impact at the most, at the end of the day, that's not going to be one area where that's useful time being spent. Looking in at the preventive control side, kind of that security camera effect, there's definitely consideration to look at to say, well, what is going to be the impact to those third parties based on just being aware that those audits are being performed, both to help educate TDT taxpayers and then just increase the awareness of TDT taxpayers, other third parties with revenue contracts to the fact that, hey, revenue audits are being performed. Everything absolutely needs to be done accurately and honestly, or else it will eventually be caught if there is anything that's not being handled in an ethical manner on behalf of any of those third parties. So as I talked about on the saying, well, how far do you go? The question we always have to look at, and that I always look at, is whatever it is that you're doing, whether it's saying looking at a certain area, going so far in depth into that area, is always ask, is this truly the most effective use of that time? Because time is always going to be limited, so it's a matter of trying to figure out how to prioritize that time to provide the biggest bang for the buck and add the most value to the organization as a whole. So as we look at the actual audits being performed, and this really says once you've got a pretty good idea of what you think you want to do in terms of revenue auditing, one huge factor in terms of managing that capacity to perform the revenue auditing activities and otherwise is just thinking about conceptually, what does the schedule look like? A few examples here is on the financial statement audit side for us as a firm specializing in governmental entity audits. Of course, all of those organizations have a September 30th year end. For those on our government services team, the busy season is pretty much from Thanksgiving all the way through March 31st, which is the CAFR deadline for those larger organizations that prepare CAFRs. And one of our ongoing challenges and objectives is always say, well, what can we do to move work out of that peak busy season, whether it's doing interim field work, performing certain transactional testing before we get into the actual year-end financial statement audit portion of the audit. On the revenue and the TDT audit side, the timing of the audits, of course, is going to be a huge consideration as well. If you're a tax collector's office, and it depends on the size of the office and how spread out the office might be in terms of where the TDT audit function falls. For a smaller tax collector's office, November probably would not be the time to be concentrating on TDT audits when tax payments are coming due. So always think about strategically, whatever you're going to be looking, is there any sort of a downtime or otherwise that work could be performed? Looking at who performs the audits, again, is just another area of resource management to say, well, what level of expertise do you need to be overseeing that work, and what is the availability of those individuals? And looking at the scheduling side, one consideration here, I think, that is one that we've looked at and talked with different organizations about is, let's say that you have a certain type of audit, again, whether it's TDT or revenue audit, and your plan is to perform 12 of those audits per year. I've seen some scenarios where it's a nice even number and the plan is to perform one audit per month is the overall plan, but consider what benefits there might be to basically handling everything. Here we call it block scheduling versus periodic scheduling. Instead of saying, let's do one audit per month throughout the year, regardless of when we're busy and other ebbs and flows in the work volume, but say instead of doing one every month, let's do 12 altogether in the couple months that's kind of the quieter season for those individuals who will be performing the audits. In addition to a better management of overall workloads, there could also be some efficiencies there because everything's being done all at once versus having to kind of pick up and put down more often by doing it only throughout the year to a very limited scale. So as we talk about the audit selection, once you've said, okay, here's what we want to look at, and here's generally how many audits we're going to perform, and when that's going to be, the next step becomes, okay, well, how do we determine who are we actually going to select for those audits? So we'll do a quick refresher on internal control because while it's not your organization's internal control. It is an important consideration in my mind to consider when looking at those other organizations that will be subject to the audit. So of course, we have the definition of internal control here, where it is designed to provide reasonable assurance regarding the achievement of objectives relating to operations, reporting, and compliance. Or in this case, really, it's that third party's internal controls and how they support the fact of what level of confidence do you have that those revenue amounts being reported and paid to your organization are in fact correct and accurate. So as we're talking about COSO, our second webinar, I believe, of this series looked at the COSO framework on internal controls in a remote environment. So I will turn it over to Janice for our Way Back Wednesday polling question.
Okay, so which of the following is not one of the 5 components of internal control under the COSO framework? Control activities, control environment, or control objectives? Once again, just a quick note, you may need to exit full screen mode to view the polling questions. So we'll give you a little bit of time to get your answers in. As a reminder, if you are having trouble answering the question, you can also submit your answer in the chat or in the question, I should say the Q&A function, and we'll be able to record it that way. I'll give you about 5 more seconds to finish. Okay, votes in. We're going to go ahead and close the polling question. And let's share the results. There you go.
All right, so it looks like we've got a handful of COSO experts attending, or those that participated in the last webinar, the internal control webinar. The correct answer here is control objectives, which about 2/3 answered that. Control activities and control environment, as we'll get to on the next slide here momentarily. Those are 2 of the components of the COSO framework. The control objectives, there is no specific item, but there are 3 categories of objectives. So we kind of went with a play on words here. But as we look at the COSO framework, really the key here we're going to talk about is the 5 components of internal control related to control environment, risk assessment, control activities, information and communication, and monitoring activities. A couple of those mostly related to control environment and risk assessment are going to be the areas that we're going to relate back a little bit to the revenue auditing aspect and say, okay, how do those considerations help us determine our plan with regard to the revenue or the TDT auditing? There are 17 principles of internal control. Not going to go through all of these, but just some of the areas looking at the control environment and the risk assessment, again, to say, okay, what are we going to look at? And as you can see on the control environment, really everything there, it's all about the tone at the top and just the overall assessment of the organization. Again, in this case, they'll be thinking about what can we gather about those third parties that are remitting those revenues to your organization. When we talk about risk assessment, and this is the external financial statement audit model, it really comes down to 2 different factors, where it's first inherent risk and then also internal control risk, to say, well, what internal controls are in place and how do those controls help ensure that the financial statements are fairly presented, or in this case, that the amounts reported and paid to your organization are in fact accurate. So first, the inherent risk definition, we have the AICPA definition here again for the external audit environment. But really here, it's just the overall fact to say, well, what risk is there that there's a material issue in terms of the revenues that are being reported and paid back to your organization? Just inherently looking at the organization, considering a variety of factors, what's the risk that there is going to be some sort of an issue, whether it's, again, due to either error or fraud? So a few considerations that we look at with regard to inherent risk. First, on the financial statement audit, again, it's very largely defined in terms of what areas to consider. It could be just the experience of key personnel, changes in key personnel, just the people that are overseeing the financial reporting process for an organization, just what's their capability and experience. With regard to operations, if there's been any changes or it's a very complex operation, that of course would increase the inherent risk, as well as just the reporting process and whether it's centralized or decentralized. Again, these are very largely put out there by the AICPA in terms of what areas to look at. So it's one where it is, again, pretty straightforward, but considering some of those areas, when we look at everything from the revenue audit side or the TDT world, there's some similar considerations that can go into place to say, okay, if you're going to pick a sample of 10 contracts or 10 taxpayers for audit, how do you determine which ones might be more susceptible to there being issues? So first is just the structure of the reporting entity. Let's say you've got a hotel and you have one that's part of a large chain. There's a large many hotels under the same umbrella with the same internal controls versus a standalone hotel. Well, there's probably more risk at that standalone hotel. The size or the turnover of the reporting entity, the larger an entity, the better chance there are going to be good internal controls in place. If there's been changes in the reporting entity, that could be a sign of additional risk. The focus of operations, and this is one where we've got a TDT example to say, if you have a hotel versus a timeshare that's doing daily rentals and might have some exempt guests that are not subject to paying tax or otherwise, consider kind of what the bread and butter is of the organization. So whatever revenue that you are receiving from that organization, if it's related to what they do and there's likely good controls over that, it's not something that they only do once a month or once a year that they're not really experts in, that's going to be indicative of a lower risk. So for instance, on the TDT side, one example we have here is if you're looking at taxpayers that have long-term rental activity, if there's an apartment complex where almost everything is a long-term lease versus a hotel or a condo that has a smaller degree of exempt rental activity, the risk of anything having been improperly reported as exempt would be much higher at the entity that has a lower percentage. It's not really what they do. The apartments, we could probably pretty safely say that they've got proper controls over the lease agreements and they're well aware of what qualifies to be exempted. With regard to industry pressure, especially in these days, looking at just the overall economy impacts of the COVID-19 pandemic and otherwise, looking at those third parties and saying, well, what pressure is there that industry is facing? That could be another area that increases that inherent risk or potentially the fraud risk just due to those financial pressures that may have that organization looking at any ways that they can maximize their cash flow and just get by with potentially not paying what they should be just because they need the cash. So looking at how we select some of the audits, on the TDT side, first what we do is we do a data analysis of really all of the taxpayer data to say, let's look at it analytically for any unusual activity in terms of total dollars, exempt rental activity or otherwise, as well as some high-level analytics for those that we have the data to say, okay, if there's a hotel, how many rooms do they have? Do we have that data? And if so, what's been the average revenue per night per room to see, okay, are there any that are substantially lower in terms of that metric to say, well, these either have a much lower than average occupancy level or there's something unusual going on with those revenues not being reported like they should. On the revenue contract side, again, a few factors, just the total revenue to say, okay, which contracts are more substantial and should those be looked at first? If you get paid on a monthly basis on some contracts, looking at just the variability on a monthly basis, annual basis, or otherwise to look for any unusual trends. If there's been any issues in getting proper documentation along with those payments or any delays, that again could be indicative of the fact that there are some issues going on at that organization and that might indicate a higher or elevated level of risk with regard to there potentially being errors or fraud taking place before those dollars get remitted to your organization. On the sampling methodology side, some of the main sample methods that are out there for an external audit environment is looking at random, systematic, haphazard, judgmental. On the TDT side, what we often will do is basically pick stratified samples to look at samples based on certain criteria. It might be based on the taxpayer type to look at certain hotels, management companies, and otherwise. So as you look at any different area, whether it's TDT or on the revenue side, look at the different types of entities that you have under the same general classification of contract or otherwise, and say, well, you want to some degree make sure that you're looking at the different types or different areas and getting a good spread out sample that does get different aspects of those taxpayers or contracts subject to audit. And one thought on the revenue side is if there are similar types of contracts that you have, let's say there's you're a larger government with an airport or some sort of large area of real estate where there's a handful of restaurants that all have some sort of a % of sales payment that is due to the organization. If you have any clusters like this that are of a similar type, it's definitely a consideration, I think, to look at some of those that are similar at the same time. If there's only a few there, again, just to have those efficiencies, kind of like we talked about from the scheduling standpoint, rather than only doing one every so often, to cluster a few together just to make the actual audit procedures that much more efficient, as well as effective by going through the same process more times and effectively getting better at it as the continued audits are being performed. So as we get to performing the audit, many of the areas here that we're going to look at are improvements that we made to our own internal process at James Moore. And first, looking at just the planning to say, okay, once you've said, here's what we're going to audit, here's which taxpayers or contracts we're going to audit, and so forth, what can you do to help facilitate that process? A few quotes that have some folks at James Moore like to say that I wanted to share here is first, just the fact that audits are won and lost in planning, and for every 1 hour of planning, 2 hours of field work are saved. So while some of these are just to kind of get people's attention, there's lots of merit to those. And I want to go through some of the areas where we've, by making sure the audit is planned as best as possible, it has helped create efficiencies both in terms of the time being spent as well as getting the best information to perform the most effective audit. So a few key elements on the financial statement side, for those probably most of you who undergo some sort of a financial statement audit, of course, there's request lists that are provided, schedules that are developed for the audit. And then one that we're going to talk about is there's, of course, third-party confirmations that are sent to banks, grantors, and otherwise to get an independent verification of amounts supporting the financial statements. On the revenue or the TDT audit side, what we've generally done is followed much of the same methodology to say, well, let's make sure that in advance of the audit, the taxpayer has a list of what is going to be needed for that audit. Same thing on the revenue side. You would want to clearly communicate, well, here's what we're going to need to look at in order to validate what you've reported to us. The scheduling is done in advance, so there's no doubt about when those documents need to be available. And then along the confirmation side, what we do on the TDT side and could really be applied to any sort of a revenue audit is we have the taxpayer validate and verify a series of information just to help confirm that what the organization has on file is in fact correct, but also potentially clue us into some higher areas of risk or otherwise that should be taken into account as part of the audit. So in those confirmation letters that go to the taxpayers, we have the taxpayer confirm their demographic information. They give us a scope of the rental activity, and then also just make representations regarding the activity that has been filed. And if they have anything they're aware of that was not correct, they do have a chance to self-report some of those issues if they are there. To help facilitate the scheduling process, we also provide a scheduling form to, in effect, give the taxpayers some level of discretion to help determine when that audit work will be performed. So I've got a few examples here. Again, this is very specific to what we do on the tourist development tax front, but one of the riskiest areas for the TDT taxpayers is the bottom half of the screen here, looking at the check below. If you have any of the following on your rentals during the period, those different items there that can be checked, those are generally some of the highest risk areas that come up as part of those audits. So in a revenue audit situation, it could be tailored the same way to basically say, okay, if a taxpayer or that third party has any of these items, we know those are going to be high risk and we want to look at them as part of the audit. So instead of just kind of realizing that on the fly, it's a chance for the taxpayer or the third party to tell you certain things and basically help you identify what those risk areas will be on the front end before you're actually outperforming that audit. This summarizes the representations, just again, kind of giving, helping establish the seriousness of the audit and making sure that that third party understands here are some of the key requirements, and also just getting that sort of attestation to the fact that everything has in fact been done properly. And then on the scheduling side, what we've done here is we had a few weeks that we would provide to the TDT taxpayers there, and basically gave them an option to select when they were available, as well as if they had any preferences. Really, the key here was it helped provide an opportunity for efficiency in the overall scheduling process, as well as being cooperative with those taxpayers in terms of just giving them a single date and time, but rather allowing all of these schedule requests to come in and then combining the entire schedule to, again, get everything clustered together to make those audits as streamlined and efficient as possible by performing them very much at the same time around each other, versus being those that you had to pick up and put down on too many separate occasions. And with that, we've got our third polling question. Janice, I will let you take this one away.
And here it is. Who should your entity's resident expert and coordinator of revenue TDT audit activities be? Your finance director, internal auditor, other internal personnel, external CPA or consultant, or Forrest Gump? Remember, as a quick note, you might need to exit full screen mode if you can't see the polling question. I'm going to give about 10 more seconds, so please go ahead and get your answers in. This is for your CPE. All right, we'll go ahead and close that question out. And let's see the results.
All right, so we've got a pretty even mix, almost half and half between finance director and internal auditor, a small mix between the others. Of course, this is one where there is absolutely no right answer. It all just depends on the structure of your organization and what you have. So internal auditor, if there is one in place, would definitely be a common area that some of these functions would go. Even though it is of external parties, it's one that we've definitely seen oftentimes fall under that purview for those that do have an internal audit function. We did have 2% that said Forrest Gump. That actually is kind of the segue into the next slide, just in terms of what those audits might look like. One thing I learned pretty early on, in addition to the fact that there's oftentimes issues, just more so than I would have ever expected before we got into the entire TDT audit process, is really what to expect as you do this. The Forrest Gump reference here is TDT and revenue audits are really like a box of chocolates. You never really know what you're going to get. Every single one is going to be different. For us, as financial statement auditors, it's kind of one where if we're doing a city audit, a county audit, whatever else, you pretty much know what everything's going to look like. There's going to be different intricacies, different accounting systems, but the same revenue streams and otherwise are there. On many of these TDT and revenue audits, you really have no idea just what exactly it's going to entail, how messy it might be or otherwise until you get into that. And that's one where I think going through this process, if you do have the areas that can be audited, is just such an important function because it may surprise you just how meaningful those audits actually are compared to what you expected going into it. So it's one that for those that said no, you have not yet done any audits but need to, that's just one more area I would fully encourage you to consider doing that because there is so many areas that can go wrong that you don't think will go wrong, and until you actually go through the process and do those audits, there's always going to be that unknown of, well, maybe there are all sorts of issues, but maybe it actually those third parties are remitting their revenues with ethical intent and a technical accuracy that the amounts are appropriate. But there is certainly that benefit to knowing that what is being done is in fact appropriate and that you are really handling your fiduciary duty to your taxpayers or other stakeholders in ensuring that your organization is being treated appropriately and getting the dollars that it should based on those agreements that are in place. So once we've just kind of figured out, okay, what is the scope of this audit? What's the taxpayer's office situation? What records do they have or otherwise? Analytical procedures, of course, one of the quick ways to get a high-level view in performing an audit and to help identify, well, what looks weird? What should you drill into a little bit more with regard to the substantive testing portion of the audit? So on the financial statement side, there's oftentimes a high-level comparison of major account balances and activity. If there's any new or unusual accounts or account balances, that of course would be one that could raise a red flag. There are certain comparisons and analytics that are done looking at revenues versus expenses versus related balance sheet accounts and otherwise. And it could be anything with the organization, just looking at any unusual activity. Sometimes it's one where we don't know what's going to be unusual until we get there, in addition to kind of our designed analytical procedures and otherwise. On the TDT audit side, what areas might be those to look at once you dig into those audits? First, we have just a high-level comparison of the gross rents the entity might have, and looking at those compared to the financial statements or the tax returns and so forth. And this could be the same type of thing for a restaurant scenario where there's a certain percentage of sales. You would look at, well, what has been remitted? What was the gross revenue based on that? And how does that compare to the internal financial statements, tax returns, and so forth? Any monthly or yearly trends in those internal records. If there's any unusual activity where there's a drop during a normally busy time when you look at the month-over-month trends or anything like that, those could be areas that say, hey, this is something that you should dig into a little bit more. Then looking at any other internal financial statements, this is one primarily on the TDT side to say that occasionally there is taxable revenue that's in an other sort of account that was not being used to prepare and remit the taxes. So just looking at internal financials to say, okay, is there anything else unusual here or otherwise that could be indicative of something that should impact what revenues are being remitted to your organization? From a risk assessment standpoint, much of this is kind of on the fly once we get out there to say, okay, well, when we did that confirmation process, which kind of falls under the inquiry side of things, what did we learn there? What fees did they have, or what other information do we have that potentially increased the risk in a certain area? The observation and inspection, this relates much back to the inherent risk to say, as we've gotten to talk to the taxpayer, see their records, what's our judgment as to their level of sophistication? If we feel that they're a very strong, they've got a strong accounting practice, or there's a third party CPA firm they have that's helping with their accounting, well, that probably means there's a lower risk and there might not be as great of a chance of there being errors in place. And then on the analytical procedure side, from looking at those financial statements, tax returns, Did we see anything that looks unusual that says, hey, let's go look at the bank statements for this month because the revenue numbers just don't make sense and we think there's something missing here. So as you look at all of those different areas, that kind of rolls in together as your risk assessment procedures to help determine where that substantive testing really should be focused. So looking at the procedures that you would perform substantively in a financial statement audit, again, there's certain required procedures. So it's very cut and dry in terms of saying, okay, accounts receivable must be confirmed, inventory must be observed when those balances are material. And then there is some area where there are judgmental procedures, again, based on what balances are significant to the financial statements or might have a special risk associated with them. On the TDT side, what we generally do is there are certain baseline procedures, again, those high-level comparisons to the financial statements and tax returns, looking at just the monthly returns that were utilized for preparing the actual tax returns and calculating the amounts due to be filed for each of those months. On the variable side, this is where we look at, okay, based on our assessment of risk and the actual activity, those procedures then get tailored based on to what degree they might have long-term lease agreements that exempt certain revenues from tax and otherwise, but that's one that, depending on those high-level and analytical procedures, those procedures are to some degree determined as we go based on what areas are determined to be more subject to error or manipulation. On the revenue audit side, really the focus here is to tailor those procedures, again, just based on the type of contract or activity. And the key question here is say, well, what's the risk related to the factor that drives revenue, and how could that be manipulated? So if there's a restaurant, for instance, where there's a certain percentage of sales that's remitted to your organization, well, clearly the factor driving that revenue is just the gross sales. But then the question becomes, well, what's the risk there and how could that be manipulated? So once you get into it, it might be one where if the restaurant has a more robust point of sale system that everything is going through there, well, that might be a pretty good resource to look at and say, well, what are the gross sales per that point of sale system? And how does that compare to what was on the returns and what was on the financial statements? If there's one that's more of there's no formal system, there's a lot of cash activity or otherwise, that's where your risk increases. And then it becomes a matter of saying, well, to what degree do we need to look at bank statements or perform other procedures to offset for that risk that we have over there being more opportunity potentially for those revenue factors to be manipulated that would then impact how much money is being remitted to your organization. On the contractual consideration side, for anyone that might have a certain contract in place, whether it be new, something that is getting bid back out again, or otherwise reconsidered, a few things I did want to throw out there in terms of if there is a right to audit situation in those contracts, is looking at if there's anything that says what documents must be made available. Generally speaking, what you'd want to do is have that be as wide open as possible. If there is any specific identification of the applicable documents that could be looked at in an audit, there may be a case where other documents become those that would be needed, but those might have been scoped out as confidential or otherwise. So that, if it does get specific, that is one area that you would want to be as wide-reaching as possible. The fact of how often the contract activity could be audited is certainly something to consider including as well, just to say, okay, well, how often do we think we would want to do this, and what is realistic in terms of the frequency that would likely be in place, or even how many years can be audited at a time. On the TDT tax side, there's basically a 3-year statute of limitations where you can only go back 3 years with regard to the audit. On the revenue contract side, you might want to look at, well, how often would it be done and what time period can be audited? How long do those third parties need to keep those documents on hand to support what was remitted to your organization? And then on the contractual structure side, one consideration too is if you do have any areas where you analyze some of those contracts that are in place and say, hey, this is absolutely a contract that could be subject to a revenue audit of sorts, but it's just, there's never going to be the bang for the buck to actually go and audit that contract. That may be something indicative of the idea that, well, maybe you don't want that to be a variable payment and you want to, the next go round, negotiate that into a fixed amount. Maybe it's based on prior year variable amounts or slightly scaled up, but you say, let's just make this a fixed amount so we don't even have to worry about anything being incorrectly reported or there being any accusations or otherwise that you should have audited such a contract but chose not to. So again, we talk about the fiduciary duty behind some of these audit functions. That's absolutely one of the important considerations because just like on the TDT side, it's one where those counties who self-administer their tourist development taxes, they basically have a fiduciary responsibility to ensure that audits are being performed. So if you have a variable revenue contract, I would always think about that the same way and say, well, how do you best manage that responsibility? And is it worth even having that variable amount that really subjects you to that potential for error or fraud in the amounts that are being remitted to your organization? A few final reminders, really already hit the fiduciary responsibility, but then always look at the startup and the learning process as well to say, if you're doing this, it's not necessarily just about the short term, get the bang for your buck and say, hey, we did these audits, we generated this much in revenue, but look at the long-term benefits as well as the education of those taxpayers or just the awareness of those third parties that such audits are being performed. Again, on the cost benefit side, that really is the intangible benefit of performing many of these revenue audit activities. It just has an increased level of honesty that you've got coming from those third parties remitting those revenues. So with that, that covers our material for today. Our next webinar will be our GASB 87, which is the lease standard update. Same time, same place next week.
So thank you, Zach. Thank you for your time today. You've given us a lot to think about. You'll see on the next slide that we have our contact information. So if you have questions today on today's topic, or if you think of them later, please feel free to contact Zach and his team with any of those or any concerns. They're more than happy to help. And once again, you'll also see the remaining 2 webinars in our 2020 CPE series for government throughout the summer. And that'll be all for today. Thank you once again for attending and have a great day.